everybody, I'm John Van Duzer, CPA and partner with James Moore and Company, and I'm here with one of my partners, Nadia Beatty, and we are going on part 2 of our tax planning series. In part 1, we covered how to calculate tax on the sale of real estate, and in part 2, we're going to discuss tax planning for the purchase of real estate. So thank you, Nadia, for joining me here while we're both in the pits of tax season.
I am glad to be here, John. Thank you for inviting me.
Yeah. So Nadia, on occasion, and I would say pretty frequently, you and I get clients that come to us and say, hey, we want to plan for the purchase of real estate. So I thought it would be helpful if we kind of walked our viewers through kind of what our process is for planning for the purchase of real estate. So how do we get that started?
So usually the first thing we ask our clients is kind of what is the purpose of purchasing the property? And there can be many different purchases or reasons for purchasing property. One could be holding it for appreciation, having a rental property, a vacation home, a second home, maybe if it's raw land, to subdivide, develop it. And then a trend we saw a few years ago that has picked back up a little bit is, of course, flipping property. So each has a different approach, tax treatment, and just brings to light a lot of different questions.
Right. So you and I, we sit here and that's the very first question that comes out, because that's like the very first question in the decision tree, right? And if they say, I'm going to be a rental property, well, you're going to approach it and think about it very differently than a flip.
Absolutely.
And so that's a really important distinction, I think, to come out immediately. And so then as we're walking through this and they say, okay, I'm going to buy a rental property, what's kind of the next phase of considerations?
So the next phase of consideration is the legal entity, and then that kind of leads to the tax structure, but we'll just start with the legal entity. So if it's a rental property, usually we recommend, hey, you need to go to your attorney, talk about your options, and put that property into some sort of a legal entity for liability protection. Not only liability protection, but of course there's the tax planning aspect of it also. And then if you have partners, there's the whole partnership to deal with regarding the legal entity and how to best structure that to protect everybody's interest.
Right. So I don't know about you, but I get the question all the time, should I buy this real estate in an LLC? Right.
Yes.
And I give the standard CPA answer, which is it depends.
It depends.
And then, say, hey, there's some liability type protection issues. You should consult with your attorney, and would encourage any of our viewers contemplating the purchase of the real estate. You need to bring in your tax professional and your attorney in on the very beginning to understand all these implications.
Right.
But then say, once you kind of decide the legal entity, there is some flexibility on the tax structure, which I think is the next area we can cover. So what are the various tax structures? Assume the LLC is going to be purchased, or the rental property is going to be purchased in an LLC. What are the options as far as tax structure for that?
So LLCs are great instruments as far as flexibility for tax structure, because there's ultimately 3 different ways that you can go. You can own the property in a single member LLC, which means that it's pretty much you're still a sole proprietor. If it's a rental property, we're going to report it on the Schedule E. No separate tax return is required. Everything is good in the world. The second option, of course, is the LLC. Most people think of LLCs as partnerships, and so you can file as a partnership. You got to have more than one owner, so you have to have at least 2. But partnerships, LLCs, tax as partnership, offer a lot of flexibilities, what we can talk about in a moment too.
Right.
And then, of course, the third option is an S corporation. The LLC can elect to be taxed as an S corporation.
Right. And so in Florida, especially with LLCs, there are some liability considerations on whether you want to be a single member LLC or a multi-member LLC. But you have the option as an LLC tax wise to pretty much be whatever you want. And that's a product of the check the box regs. Another one that you can possibly be is a C corporation, which does have some limited applications where that makes a lot of sense, especially in the foreign realm or in a holding company type situation. The C corporation can make a lot of sense, but for the most part, we see a lot of the pass through, disregarded entity partnership or S corp or S corporation as the ownership structures. And I guess, as we're looking at the tax structure, what kind of considerations are we looking at in order to help them make this decision?
Let's start with a partnership or LLC, and then we can move on to an S corporation.
Okay.
So with a partnership or LLC, you have to have two owners. So that's usually the first consideration. Is it a husband and wife? Is it outside investors? If they're outside investors or a husband and wife, will usually choose partnership or LLC. So there's a lot of benefits for a partnership or LLC. There's a ton of flexibility with income allocation, distributions. There's also some tax benefits of contributions of appreciated property or even distributions of appreciated property, which we can't get in an S corporation.
Right. Yeah, with that income allocation as an S corporation, it's per share per day, right? It's very rigid.
Right.
The LLC structure gives you that flexibility to have a waterfall or returns that change over the performance or the life of the investment, which can be really helpful as the professionals are making their deals, right? And I always tell my clients, like, what did you agree to economically? Why don't you get that figured out, write down what your deal points are, and then we'll craft an operating agreement to match the deal you made, not the other way around.
Right. Yeah, and there's a lot of flexibility as far as like one partner puts in the money, the other puts in the sweat equity. In a partnership, we can craft that operating agreement to kind of allow for those types of situations.
Right. So when we're looking at these tax considerations when you're purchasing a property, I think one of the big ones is, the opportunity to accelerate depreciation. So why don't you tell us about that?
So accelerated depreciation, bonus, Section 179, we hear that all the time. Those are still around. They haven't gone away. Last year, we were able to take what they called qualified improvement property. And this allows the interior non-structural parts of the building. This has to be non-residential property to qualify for bonus depreciation. And we had a lot of clients who took advantage of this over the last couple of years using that QIP designation. But the accelerated depreciation just allows you to break down the components of a building, take those 15, 5, 7-year lives and be able to expense it all in 1 year. And so when it comes to tax savings or even stimulating some sort of a cash flow for the business, this is a great opportunity in rental or real estate.
Yeah. And so we're big fans of a cost segregation, which is a formal study on a acquired piece of property to actually break it down into its components for tax lives. And the benefit of that is with bonus depreciation now, you can buy a piece of property, you can do a cost segregation, and anything that is classified as that 5, 7, or 15-year property, like land improvements and furniture and fixtures and that sort of thing, can be depreciated in the first year. And so what we're finding is, especially in like multifamily, there's these large acquisitions and there's a very sizable portion of the gross purchase price that's depreciated in year one,
Yes.
which can be very substantial. And I think leads to one of those tax structure considerations on partnership versus S Corp, on whether or not you would have the basis under an S corporation to actually even take those losses if you were to get them, right? One of the benefits of partnership is you can claim basis for the debt of the partnership, and then that's a differentiator between the rules for S corporation and partnership. So it's a very big deal to think about, what is depreciation going to look like for this entity? What are the losses that come from this entity going to look like? Now,
Right.
we're really good at generating losses, but the tax code does have something called the passive activity rules. And so that's something we constantly have to think about. So why don't you kind of give us a high level view on what the passive activity rules are and how that relates to real estate?
Right. So we see this all the time. A client comes in, they purchased a piece of property. They're like, oh, I'm going to get all of these losses in the first year. And we have to be the bearer of bad news and say, no, unfortunately, we can't take these losses in the first year because you were passive in this investment. And the passive activity rules are a trap for many investors in real estate because they don't understand those rules. And ultimately, the IRS says, hey, you need to look at how active you are in this investment, in this venture. And they have laid out specific rules, our rules, percentage of the activity rules that you have to pass to prove that you materially participate in the activity to be able to take those losses. If you don't pass the rules, then the loss limitation is around $25,000, but it's phased out for higher income taxpayers. So that can be a huge disappointment if you're expecting to be able to take significant losses in the first year.
Yeah, and good news is there's an exception for real estate professionals. So
Yes.
what's really interesting is if me and a real estate professional are partners, they potentially could benefit from rental losses where they would be passive for me because I'm a CPA and that's my profession, not real estate. So it's really important even when projecting those losses to understand, those limitations. The other thing with passive limitations is passive losses are only limited to the extent that you don't have passive income. So one of the very first questions is on a passive investor, okay, you're going to have passive losses, but do you have any other sources of passive income that you could benefit with those losses? So it really does take a deeper level of tax planning to really think through all the implications of this purchase.
Right. And there's also,
go ahead.
I was going to say there's also the option of aggregation. If they have more than one rental activity, you can aggregate those activities into one and only have to meet the rules for that one aggregation.
Right, and if you have a self-rental situation, you can also aggregate with your trade or business, which then it's not really considered a rental activity. It's considered active like your trade or business. So there's a lot of aggregation. The passive activity rules are very complex, but it's something that you and I dealing in real estate, we deal with every single day.
Absolutely.
When we're looking beyond the rental aspects and we start getting into more of the ordinary income, so like the flipping or the developing, what's one of the biggest considerations we have to think about?
Self-employment tax planning, that's probably the number one consideration. And this sometimes can also surprise clients. Probably the two biggest areas that we see this in currently are flipping property, and then Airbnbs are another surprise to individuals. So flipping property, if you flip a property occasionally, it probably doesn't rise to the level of an ordinary trade or business and is not subject to self-employment tax. But if you're doing 2 and 3 flips a year, this starts becoming your business, there is a possibility that you're going to be subject to self-employment tax when you're flipping property.
Yep. And so this is another difference between the partnerships and S corporations. So as a rule of thumb, if you kind of give that high level rule of thumb, I always say rental activities are great in a partnership type setting, but the more short term or active holdings are probably better in an S corporation. And the biggest benefit there is those S corporation earnings aren't subject to self-employment tax. And when looking at the S corporation rules, you really got to look at and say, okay, there's some salary requirements by the IRS. There's other type planning that you have to do to accommodate an S corporation. But it is one of those areas where there can be substantial savings just on that self-employment tax as a difference between a partnership and an S corp.
Yeah. And another recommendation that we usually have for clients is if you're going to have rental real estate and you're going to have your flipping operations, sometimes to segregate those and put those into 2 separate entities. And then that way you do have the option of electing S corporation for your flipping activity, but keeping your rental real estate in a partnership. So try and keep those as separate as possible.
Yep, and we see that all the time. And I think, kind of one of the other overarching themes is planning for the ultimate disposition, right? Like I think about like even the accelerated depreciation and the cost segregation. That's depreciation is a zero-sum game, but the time value of money is what makes that so valuable, right? Getting deductions today as opposed to over 30 years is a big deal, but that completely goes away if you're just going to sell the property a year later, right? So as we're thinking through all of the planning and structuring, you almost have to say, what is your exit strategy or what's your investment horizon on this property? Is it something you're going to hold forever? If so, we really need to think through estate tax consequences and implications. Or is it something you're going to hold for 5 years? If so, we need to think about what does that look like in 5 years and what's the best way to sell? Like, how do you do things? And so that's another one of those considerations we think through.
Right. But along the estate planning, John, just to remind everybody, we see this constantly, is when somebody is going through their estate planning, or maybe they haven't consulted with a lawyer and an accountant, they automatically think that they need to put their children on the deeds, that it's just going to help the assets pass to their children. And it's probably the worst thing that you can do for your child, because they won't get that step up in basis of the rental property, of the personal residence, whatever it is. So as you're going through this, definitely consult with a lawyer and your CPA to make sure you're doing it correctly before making any big decisions.
Yeah, and keep tuning into our series, because part 4 is going to be on estate tax planning, because I think any of these other considerations you kind of have to have the estate implications in with everything you're doing. So
right.
That's all the time we have for today. So thank you, Nadia, so much for your time. I know it's a very busy time of year for the both of us. I'm sure you and I will be up late reviewing tax returns. But thank you so much for all of your time. Thank you. And then continue to tune into our series as we continue talking about tax planning for real estate.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.